Hi, good morning, everyone. Welcome to our webinar on student debt, an overlooked barrier to attract and retain talent. My name is Greg Grimm. I'm the Vice President of Employee Benefits here at Exude. And for those who are unfamiliar with Exude, we are a consulting firm specializing in employee benefits, well-being, and human capital. We all know today how important attract and retain talent is. And as advisor and consulting firm, we're always looking for new, innovative benefits to discuss with our clients. And student debt is one of those topics that's getting a lot of attention. We are excited to talk to an expert in the space of student debt. Today, we have Emeka Ogu joining us from PeopleJoy, a company that helps organizations get equitable student debt relief and education assistance benefits. Emeka, welcome and thank you for being on the webinar.
Greg, thank you for having me. Really excited to be here and happy to meet everybody virtually today.
All right. So Emeka, do you want to give a little background about yourself, the organization, and we'll go from there?
Fantastic. Thanks again, Greg. As you mentioned, PeopleJoy, we're a financial wellness company with a heart for helping others. We partner with employers looking for solutions to attract and retain talent, address the gender and racial wealth gaps, and support mental and financial wellness. We're headquartered right here in Philadelphia. We were founded in 2016. And a little bit of a personal story about myself. I wasn't, before the question we always get, and it's a great question, is, Emeka, how did you get into the student debt space? You know, it's not something that one sort of grows up and says, hey, I want to help solve the $1.74 trillion student loan crisis. So I started my career in financial services in an investment bank in New York during the Great Recession. And that was really where I saw the arc of what the lack of financial literacy can do to a country and to individuals there at Merrill Lynch, where I worked in our investment management and guidance group, helping oversee $315 billion of assets under management. Went back to pursue my MBA and have really spent the last 14 years at the intersection of finance and technology, really focusing on how do we help people remove the roadblocks to financial wellness. My why, my personal story behind PeopleJoy is that between a business school for myself and medical school for my wife, we had over $400,000 of student debt. And I can tell you that that delays your ability to save for retirement. It delays your ability to buy a home. And really, every decision that you make in life is focused around navigating that debt. And the reality, Greg, is that there's 46 million Americans like me. So that's 1/4 of the workforce who are making these decisions, both career decisions and how long they stay with an employer. It's really impacted by the amount of debt that they have. And I'm a serial entrepreneur. I have an electrical engineering degree, and I'm one of those folks who I like to roll up my sleeves and fix things. And this is a problem myself and my wife were dealing with, and we knew a lot of folks were dealing with. Remove those roadblocks to financial freedom. And really, when you dive into it, I guess before I jump into it, just want to make sure, can everybody hear me and see my slides?
Yep, we're good.
When we talked with employers and we asked them, what are your top workforce priorities? What are areas that you're looking to solve for and are important to you as an organization? And it really came down to 4 areas. And these are the areas that we focus on and really work with employer organizations to solve. The first is supporting diversity, equity, and inclusion. Since the murder of George Floyd, this has been a topic of concern for a lot of employers. Specifically, how do we help address the gender and the racial wealth gaps? But not only in an equitable way, but in an impactful way. It's one of those things that is easier said than done. What most folks don't understand with student debt, we all know about that 1.74 trillion in student loans. What most people don't know are that 2/3 of that outstanding student debt are owed by women. And we work with a lot of organizations where the ratio of males to females skews more towards females, especially within nonprofit industries. And so you have this situation where women are pursuing more advanced degrees than their male counterparts. So they're coming out of school with master's degrees and PhDs. But at the same time, unfortunately, there still is a pay gap between men and women. So they're going into the workforce where they're getting paid less on the dollar than their male counterparts, but still have to save for retirement at the same exact rate. So that wealth gap between genders just widens over time. And when you look at student loans and tackling how do we address the gender wealth gap, because women hold nearly 2/3 of the debt, it's an impactful way of addressing that. The same thing can be said with the racial wealth gap. The Brookings Institute did a study and found that the wealth gap between white and Black households between the ages of 25 and 4 years old is 12x. Okay, when you take that same wealth gap and remove student debt from the equation, it takes it from 12x to 5x. Now that's still a gap there, but it's 7x of that gap is towards student debt. And so when employers are looking at how do we address the racial wealth gap in an impactful way, in an equitable way, a solution that we can offer to everybody, student debt is that area, because again, is disproportionately going to impact women and minorities. The other area is supporting mental and financial health. Since the COVID pandemic, we're still in it, but we talked about that a little bit in the pre-call with RSV and everything else happening out there, people working from home or working remotely, just mental stress and financial stress has been at an all-time high, right? With inflation being where it is. I already shared my personal story about $400,000 in student debt. And I can tell you, it doesn't matter if you're making $1 million a year, if you're making 20,000, when you have money leaving your account every single month because of student loans, it's impactful. It creates stress. We know that 78% of folks with financial stress say it distracts them at work. We know that people dealing with student debt, when they're calling their servicers, trying to see if they qualify for loan forgiveness, going through those hurdles, they're doing that at work. It's taking them out of their productivity at work. So we know that by helping address some of the financial pain points that employees are experiencing, it helps support mental and financial wellness. And then we always talk about attracting and retaining talent. We know that 7 out of 10 people entering the workforce, would actually prefer an employer to provide a loan contribution over a 401k match. We don't advocate that, right? But that just gives you a sense of the stress, because the reality is the average student loan payment is $400 a month. You've got that leaving your bank account every month. That is you're thinking about that before you're thinking about saving for retirement, for example, because that's actually there. That's something that you're dealing with. It's behavioral finance, right? Where people would rather avoid a loss than seek a gain. And that's what we've seen when it comes to attracting talent. But a common misconception, Greg, is that student debt is a Gen Z issue, right? It's something that once you get to the age of 30, it goes away. The reality is that it's an every demographic issue. In fact, baby boomers have the second highest amount of debt of any age demographic group in the United States, not only because many baby boomers went back to school after the Great Recession, when a lot of folks, got laid off and wanted to upskill and reskill, a lot of them also took out debt for their children or their grandchildren. And so because of that, they have debt in their name for themselves as well as their children. So it's not just about how do we attract new talent, younger workers. It's also about how do we help with solutions to retain our existing employees that are struggling with student debt. And when it comes to that, and the reason why that's so important is that in order to, because every employer I talk about, everyone's focused on obviously saving for retirement and helping sort of their employees and themselves focus on long-term solutions and building that long-term financial stability and security. But Greg, if you've got holes in your short-term bucket, right? If you're not saving, building that solid foundation in the short term, how can you possibly get to the long term? How can you possibly begin saving for retirement? In fact, 401k plan leakage has never been at its highest than now because of a lot of what's going on there. And so part of, the Aspen Institute actually performed a study on short-term financial stability and building a foundation for security and well-being. And what they identified was that there's really 4 financial cushions that one needs in order to really build that foundation for long-term financial stability and security. One is routinely positive cash flow. So what does that mean? That means more money coming in, at its most basic term, more money coming in than what's coming out, right? That means that your credit card payments, your debt payments, and so on and so forth don't exceed the income that you have coming in after taxes. It's having liquid savings, so the ability to essentially sustain unexpected economic shocks, emergencies, and things of that nature. Everyone's probably familiar with the Federal Reserve report that said that nearly 2/3 of Americans could would be able to cover a $400 emergency expense, right? Which is shocking, but true. And so having access to liquid savings where you don't have to go after high interest loans, lenders, and payday loans and things of that nature. Access to high quality credit, obviously very important at all times. Again, so you're not tapping into high interest rates. And then strong social networks, meaning really an ability of people who can support you, whether that's bank of mom and dad or bank of brother and sister or things of that nature. But having access to strong social networks, those are what they identify as the four financial cushions. So when you look at student debt and our focus on how do we help eliminate student debt, it's really with these things in mind. By eliminating student debt, right, by reducing the amount of debt that an individual owes, that's going to increase the routinely positive cash flow, because that's that $400 a month average that we talked about, that's not going to be leaving their bank account, right? That's going to increase their liquid savings because it's going to reduce their debt to income ratio, which means it's going to improve their credit. And so when you look at really what we're focusing on, and it's focusing on building those four financial cushions. And one of the benefits that nonprofits have is that there are already built-in federal programs designed to solve for this. So the Public Service Loan Forgiveness Program is a program that was administered in 2007 during the Bush administration. And what they saw was there was going to be a shortage of public servants, of nonprofit employees, of teachers, firefighters, nurses, and in order to in order to compete with the Silicon Valleys of the world, to compete with the tech firms, they instituted a program and policy designed to attract and retain talent, and that's the Public Service Loan Forgiveness Program. And folks on the call may be familiar with that. If you are, put a thumbs up in the chat. But the program essentially says, if you work for a nonprofit, any nonprofit, for a period of 10 years, it doesn't have to be consecutive, the Department of Education will forgive your federal loans tax-free, right? And only if you work for a 501c3 organization. And so the average nonprofit employee qualifies for over $40,000 in student loan forgiveness through this PSLF program. And we know when implemented correctly, that program is going to attract and retain talent, it's going to address the gender and racial wealth gaps, and it's going to support mental and financial wellness. And it was really, again, stood up. That was the promise with the Department of Education to nonprofit and public servants, was that we're going to forgive your loans tax-free after a period of 10 years. The unfortunate reality, though, Greg, is that that program has had a 99% failure rate. And it's failed for a number of reasons. And, to really sort of dive into the technicality of it, one, there's really 5 core areas of what one needs to do to work for a nonprofit. The first is you have to work for a nonprofit, right? So I think everybody checked the box on that one. Although in the past, if you worked for a nonprofit, but let's say your payroll was done through a PEO, right, a professional or employer organization, and that PEO was considered a for-profit, there were borrowers who were getting rejected because they were told, well, the employee identification number on your pay stub is a for-profit entity. Even though you work for a nonprofit, you technically work for a for-profit. They were getting rejected for that. Luckily, that's been resolved recently with the new administration. The second is you had to have a qualifying loan type. So the government has 3 loan types. You have Perkins loans, you have FFEL loans, you have direct loans. So there's 3 loans. Only one of those loan types, the direct loan, actually qualifies for loan forgiveness. So 2/3 of the loan types that the federal government offers don't out of the gate qualify for loan forgiveness. And so not uncommon for us to be talking to a teacher or a nurse who's worked at a nonprofit for 10 years and thinks in year 10, okay, this magic wand is going to come and forgive my student loans, only to find out you have FFEL loans. And guess what? Those last 10 years of payments did not qualify for loan forgiveness, right? The government has 9 repayment plans, right? So you have 4 income-driven repayment plans, you have 2 standard plans, you have extended plans, you have graduated plans, right? So you can be in any one of those 9 plans. Only 4 of the 9 payment plans qualify for loan forgiveness. So again, we could have that nurse who said, you know what, people, I was in a direct loan, I had the right loan type, but we're not in the right repayment plan, okay? And then now you may have that individual who's in the right repayment plan, but guess what? You have to recertify your income every year. If you don't recertify your income, you're taken out of the plan. Like you're in an alternative plan, which doesn't count for loan forgiveness. You also have to certify your employment history every single year with your current employer. And if you had prior nonprofit work, certify it there as well. And so it's not uncommon for somebody who after 10 years has not certified any of their employment history. They're now trying to chase that employer from 9 years ago, 8 years ago, do that cleanup work, and finding it difficult to get in touch with that employer. Maybe that nonprofit is no longer in existence, right? So how do you even show proof that you work for that nonprofit? So it's when you really dive into the weeds, Greg, it's not surprising. You're actually like, wait, only 99%. It's not surprising that how difficult it was. And really the unfortunate reality is that because you've lost its luster and people have just heard about rejection and not about success stories, it's lost its original intent, its original goal of attracting and retaining talent. People are going to nonprofits now, not believing that they're going to get their loans forgiven. And therefore, if they're getting opportunities and offers to, let's say, work at a for-profit institution, they're taking those because they no longer see that benefit of, hey, I'm going to work as a public servant, as a in a 501c3 and get my loans forgiven. So what's the draw here, right? Obviously, there's the mission of the nonprofit, but at the end of the day, people also need that financial cushion that we talked about, right? And if I'm not getting it here, and my situation has changed, where can I go to get it? And that's really where we come in, right? And our goal and our opportunity is to turn that 99% rate of failure, Greg, into a 100% success rate. And we're doing that by guiding their employees through every step of the way with managing their loans to help them qualify for public service loan forgiveness and making sure they cross their T's and dot their I's on an ongoing basis, on an annual basis, right? And really what we're seeing on our side is, I mentioned earlier that 40,000 average, we're seeing numbers anywhere between 40,000 to 150,000, Greg, with the individuals that we're working with. And what we're seeing is that that's once again restoring faith in that program. Again, it's a federal program, right? And we're seeing that turn into not only are people getting their loans forgiven and they're happy about that, but it's giving them an additional incentive to stay with that employer, to stay in the nonprofit space, which is a win-win on both sides, right? Because we need more people who are public servants, who are doing the work that we need as a society to thrive, who are doing the things that nobody sees on a daily basis, but it's what's helping our society grow. And so it's a win-win on all sides with that.
Quick question for you, Emeka. How are you getting involved, right, with the individuals through this program, right? That comes the first question to my mind about the navigation piece.
Yeah.
Right. And so maybe give us a little bit more of insight and details on kind of what that process looks like and the partnership with the individual.
Yeah. So really, it starts with establishing trust, Greg. Oftentimes, we're dealing with individuals who've just been frustrated, right? A lot of times they've tried it themselves. They've just been given the runaround. It's confusing work. If you've ever tried to, do taxes on your own, you realize at some point you say, you know what, it's just not worth it for me. And so the first thing we try to do is educate. So when we talk with an employee or a borrower, we start with a webinar. And it's a student loan 101 webinar where we're going from, hey, this is what happens when your loans are out of grace period, to anything from what happens if I go into default. How do I understand private loan versus a federal loan? Refinancing versus consolidation. Really, we go into the weeds of it, Greg, because our first goal is to educate them on understanding the space. A lot of times we may talk to a borrower and we're like, do you have federal or private loans? They don't even know. They haven't even logged into their account in years. They just know that every year for the last 20 years, I've been making payments, right, and I don't know what's happening. So the first thing we want to do is lift up the hood and see what's going on, and let them know if they qualify for things. So we have a software tool that analyzes all that information, and we'll give them a number, right? And then they can actually talk with somebody on our team to walk through our analysis of what it actually is going to take to get there, what cleanup work needs to be done, if any, and then how do we get them on the path going forward so that they're set up for success. And then we follow that up with again, it's a lot of touch bases where it's a high touch solution where we're meeting with them on a quarterly basis. to keep them up, get up to speed, do check-ins and see what's going on and guide them every step of the way. So it's a relationship. It's an ongoing relationship. It's not a one-time sort of magic wand solution.
That was kind of my second question of it, is like, it seems like no matter if you just graduated or 5 years into repayment or 15 years into repayment, right? I think that's real helpful to understand, is it's the introduction piece, but then it's the ongoing support, right? Because this is not something that's just an overnight fix. And it seems like the guidance for that is so important through their journey.
Exactly. It's just like flying a plane, right? You've got to keep adjusting that every few degrees, every so often. Otherwise, you're going to end up in a different destination. So we're constantly course correcting anytime there's a change in income, tax filing status, number of dependents, pre-tax benefit, anything around that can trigger the calculus for your monthly payment and loan forgiveness. So anytime that happens, we want them to tell us. And that's why we have those quarterly check-ins, because to be honest, something like that's going to happen every single year, right? Especially we're making the time now. It's not uncommon for someone's spouse to be on leave, right? Well, guess what? If that income lowers, then that changes what you have to pay, and that increases the amount that you can get forgiven. And so most folks treat student debt, or treat debt in general, as something you don't want to think about. It's like going to the dentist. So they sort of set it and forget it. And our goal says to change that mind shift to the same way you work with a financial advisor and rebalance your investment portfolio based on market outlook and how things are going and what your goals are, is the same way we want borrowers to look at student debt. It's something you need to rebalance, look at every so often, and make sure you're on track and in the right way. Don't just set and forget it, especially if you're eligible for public service loan forgiveness, because we know the stats are not in anyone's favor.
Another question, I think we have employers of all sizes on here, from 15 employees to 2,000, right? Give us an idea of maybe just engagement levels you're seeing, or are there different structures or communication you've seen work, right, with different size organizations?
Yeah, that's a great question. So typically we always tell folks, you should benchmark that 1 in 4 employees have student debt, right? We talked about 46 million Americans. It's about 160 million Americans in the workforce, right? So about 1 in 4. Again, depending on the skill level required in your organization, if a bachelor's or a master's degree is the minimum, that number can skew up higher to 30% or even higher. If it's a very young organization, we know that 7 in 10 have loans. And as I also mentioned, baby boomers are the second largest demographic. So we typically aim to have 20 to 25% sort of participation in this. And this is, again, over an 18-month period. And the reason why it's over an 18-month period, Greg, is, our main method, the most effective methods of communication that we've seen are email, right? One, giving that email out to that employee with a direct call to action, right? You don't want to have it too busy to either attend the webinar and learn more, or engage immediately and get an assessment. And then we're sending out those emails typically on a monthly basis. The reason why we do it monthly is what we've learned with corporate communications is typically a 15 to 20% open rate. Anybody on this call who's gone through an open enrollment period knows exactly what I'm talking about, in terms of just, you have to over communicate to get the information out there. And so we typically expect 5 to 7 touches, right? A sort of outbound outreach in order to get everyone aware of what's going on. So we're going to do that over typically a 6-month period, and then afterwards quarterly. In the last 18 months, though, we've seen that 20 to 20% engagement rate compressed over a much shorter time period, primarily due to the limited PSLF waiver, which expired on October 31st, the Biden forgiveness, which is on sort of hold right now. So there's just been a lot of anxiety among employees of, do I qualify for these? I want to know. And so where it's been more, they've been reaching out to us. And so they've been reaching out to their employers saying, hey, we want to know, do you have insight and information? And so we've seen that number compress more recently. But I would say email and webinars have been the most effective, but we've also done mailers, text messages, and everything in between. We like to meet the borrower where they are, right? And so that initial communication from the employer side and with us is through email. But once they're a client of ours, we ask them, do you want to be text messaged, phone called, or email, right? Like we want to work in the format and medium. There's 4 or 5 generations in the workforce. Some generations prefer text, some prefer phone call, some prefer email, or some hybrid of both. And so we want to work with them where they are. Again, it's about that relationship building and really being that trusted advisor when it comes to their student debt and managing that.
Another question, maybe an example of an organization that you work with successful implementing this program, right? So just kind of work through, you don't have to name, but size, location, kind of how it came about. I think that's always helpful for individuals on the webinar to figure out, okay, how did this actually go through?
Right. So I want to share a couple of things. One I want to talk about specifically at an employer level. So one organization we worked with, large nonprofit, 14,000 employees, so they're good size, right? And our goal was to help their employees. I see if they qualify for loan forgiveness, and essentially enroll them and navigate them through that process. And so when we launched there, I would say typically, again, we saw that 20% saturation of where we expect the number of employees who have student debt at about I want to say the 10-month mark. And we started to get people set up, get them to the finish line. And what we saw was that, in the last calendar year, for example, we've been able to help those employees realize $2.8 million of forgiveness, right? Like, this is actual getting that letter from the Department of Education saying, congratulations, your loan balance is zero. In some instances, you're getting a refund check. And we're on track to save them on average $4 million a year for the next 10 years. Because again, as we said, this is a marathon, not a sprint. You're going to see some employees who are at year 10 already and are going to get their loans forgiven in the next 12 months. And some people who are just entering the workforce and they're 9, 10 years out, right? But what we're doing is providing that forecast, letting them know that, hey, based on where you are today, here's where we forecast your forgiveness is going to be in 10 years from now. And we're course correcting and adjusting. So in terms of dollars saved, again, close to $3 million this year with this employer, on track to get $4 million a year for the next 9 to 10 years. But the other thing that was really, really interesting to us is we said, well, we want to look at and compare the attrition rate of our members, people who've enrolled with PeopleJoy, versus the general population. Because again, it's great that we're helping your employees put money in their pockets, and there's something to be said about that's just the right thing to do. And for some employers, that might just be good enough. You help my employee put money in their pocket, that's money that I don't have to spend, right? That they don't have to spend, therefore I don't have to spend, because they can now put it towards other things, right? So thank you for that. But we wanted to measure and see, are we once again restoring faith in the public service loan forgiveness program? The only way to do that is to measure actual attrition. So we measured the turnover rate among our members, so who is with us or was no longer with us because they no longer work with that employer, and comparing that turnover rate versus their normal turnover rate. And what we saw, Greg, was a 41% differential.
That's awesome.
A 41% differential. And I can't tell you the number of times our student loan advisors have been on the phone with an individual and have said, who's told them, I am in this industry, I'm here because you told me that I have $70,000 of forgiveness in 2 years. So
it's huge.
I'm waiting for that. Now, we don't measure the attrition rate once they get forgiveness. I don't.
Yeah, right.
Again, we always say, look at it like a golden handcuff. So I used to work on Wall Street, right? And we got our bonuses in the end of Q1, right? So December ends, I'm not getting my bonus until February, maybe March.
Yep.
If I get an offer to go someplace else, I was not leaving in January or February, right? I'm going to wait until that money hits the bank, till it vests, wait a little bit more. And why would I forfeit the bonus for the time that I put in, the effort that I put in? And public service loan forgiveness is that golden handcuff for the nonprofit space, right? And what we're encouraging employers to do is look at it like that. Like, you should look at this and say, hey, if my employee is sitting on $40,000 to $150,000, that's total comp. That's money that the Department of Education is paying that no longer has to come out of my employee's pocket. And they only get it because they work for a nonprofit, which I am. The other story I want to share is more of so that's the business side for the employer, is more of a personal story with an individual. So we had one teacher who had $60,000 in student loan, right? And she was one of those folks who was already at the year 10 mark, but was just not getting through, kept getting these mysterious rejection letters. And we were going through with her through every step of the way. And, she's somebody who also, she had a very personal story with us. So, her and her husband were going through an IVF process, and they had to take out money for that, and to put on some additional debt. Mm-hmm. And her thought process was, if I get my student debt forgiven, right, this essentially buys my baby. Like it starts my family,
Absolutely.
you know, and so we were able to help her get to the finish line. And she got that 60,000 of debt forgiven, and she was so grateful for it. She gave a nice testimonial for us. But that's why we do
Yeah.
what we do. That's the people joy, right? It's that piece of it. And you know, it really resonates with us. And if that doesn't pull your heartstrings as an employer, right? And that's really, there's not many benefits that do that, right? That can offer that. And so that one resonates with me because, you know, although we work with employers, we work with individuals who
Sure.
are employed at those organizations. And so it's our job to and we hear those stories on a daily basis. We know the why behind it. And I can tell you that for a lot of these individuals, loan forgiveness, they're putting it up there with like the birth of their first child, right? In terms of the happiness that they get. And the fact that they can now associate that happiness and that success with an employer offering this for them at no cost to them, you know, only helps to establish that loyalty to that employer.
That's fantastic. Other question, you mentioned the DE&I initiatives or strategies. Have you any examples where they're including the PSLF as a part of initiatives or strategies, right? I mean, again, just idea sharing, anything else, some maybe takeaways from individuals on the webinar.
In terms of the employers
Yeah,
themselves?
yeah. I mean, including this as a DE&I initiative or strategies, right?
Yeah.
As rolling out People Joy, because I mean, again, you look at some of the statistics on some of the barriers, right, and the racial divide. It's unbelievable to see that the times 7, times 10, right, in certain underserved
Right.
communities and areas.
Yeah, exactly right. So we've seen that in a number of methods, right? And so we've had organizations that have specifically said, we're going to stand up a student loan repayment benefit, for example.
Yeah.
So in addition to loan forgiveness, just to Greg, to your point, there's a couple of other educational assistance benefits that can be offered, right? So one is student loan repayment assistance, where an employer is making a direct contribution to their employee student loans as a way to accelerate the debt payment. And so we've seen some large organizations who said specifically, we're going to stand up a student loan repayment benefit specifically geared towards minority employees, for example, or female employees, and setting it up more direct that way. Our sort of stance is always with public service loan forgiveness is something that you can offer to all employees. You don't have to specifically target female employees or minority employees, but know that it's going to disproportionately impact them nonetheless. So we're definitely in our conversations, especially with larger organizations that have a chief diversity officer for speak, where we're starting that conversation with them as well, because they're all looking for, Greg, impactful solutions, measurable solutions. So we know when we're going with an organization, when we're giving you data, we know that it's going to disproportionately have more females enrolled, more minorities enrolled, because they tend to have most of that student debt. So it's something that we're seeing, it's bringing different groups to the table. Whereas before, the chief diversity officer, if that's a separate role, may have had a separate initiative from the CHRO or the COO. This is something that everyone can get involved in and know that, okay, there's data and stats in it that can benefit the reports that the chief diversity officer has to run, the chief human resources officer, the chief operating officer, and we provide a lot of that data. So one of the things that we can do and we incorporate is we can add survey data and things of that nature, or attributes such as gender, race, for example. So that person can actually see, who's overseeing that initiative, can actually see that measurable impact. I mean, it's all about measurement at the end of the day. And so our job is to show the total amount of forgiveness at an aggregate level that the organization is seeing, that we can break it down by year, we could break it down by gender and things of that nature, and then really show that it's working, show that these are, because it's very, DE&I is such an important thing, but it's easier said than done, right? And actually implemented. And so this is just one measurable way and something that we know is going to be impactful, and we have the results to back it up.
Awesome. So I think we answered most of the questions. Maybe last was just, if someone or an organization wants to start a partnership with People Joy, what does the process look like? How easy to get started? Kind of talk us through a little bit about that.
That's a great question. And I'll put just really on the slide here, just some context stats for us. So Adon Navarrete, who's on a call, is our director of business development. But really, getting started is really straightforward. We, as you mentioned to you, Greg, here, we're a high touch service on the employee side, but also on the employer side, in terms of, we manage, a lot of the marketing, the employee outreach and things of that nature. So this can be as turnkey as possible. There's not a lot of technical integration that's required. So really what an employer needs to get started with us is just we need their logo and their email domain. So it's pretty straightforward to set up. But in our we charge, it's a flat fee. So it's something that's really simplified for the employer. And our goal is to have a 25x return on investment, right? In terms of cost versus potential forgiveness found. And we don't charge any success fees or anything like that. It's a flat fee, so employers can understand that. And really the goal is to create value and build to the finish line. And then there's also, again, what we want to do is we'll have that conversation with the employer to see, what are the best solutions out there for them. We really have, Greg, what I would call is a crawl, walk, run strategy, where, and those are different sort of buckets that an employer can work with us. Crawl is simply, let's help you get access to federal dollars, right? There's free government money out there with a 99% failure rate. It's a 99% chance your employees don't get through this. The incentive of them getting it is that they work for you. Let's help them get that, right? That's our crawl phase. Walk is, we have a tool, for example, on our platform that's called Spare Change Roundup, which think of it as a virtual coin jar, Greg. You go to Starbucks, you order the latte for $4.80. We round that up to $5. So your employee's debit card, right? Not their credit card, sorry, their debit card. Yep. That 20 cents is then applied to their student loan. It's their principal. So just think of all those micro transactions that are happening every day on that debit card. And so at the end of the year, your employee may be looking at an extra month of loan payments directly to their principal. And we all know paying down principal is great because it helps reduce the amount of interest that builds on top of that. So that's that walk phase. And then run is, an employer might say, you know what, People Joy, I actually want to put dollars to my employee student loan. So if they're paying $400 a month, I want to put a $100 a month contribution. Now, obviously it's more expensive, but now we're running, right? Because now you have a tool that not only focused on retention, but also retaining talent. And we always tell our nonprofit partners, start with crawl, right? Let's get access to those millions of dollars of loan forgiveness. And then we want to walk and give your employees some self-help tools. We can do that. And if you're ready to run, we can set you up with that as well. But it's an ongoing process. We're building it up. So when we're meeting with an employer, the first place we want to see is where within that, crawl, walk, run, does it make sense? Yep. And then we'll get set up from there. But the setup process is fairly easy and straightforward. And what most folks like about working with us is that it's low touch on your side.
Well, thank you. I really appreciate you going through the program, bringing awareness to this. I mean, again, that statistic of the 99% failure rate is mind-blowing, right? And so now more than ever, do you need an advocate, right? And a team behind you to help navigate that and bring awareness to it. So,
and one thing I wanted to mention on that, Greg, with that 99% failure rate. So we actually spoke, so the new administration is very aligned with figuring out ways to try to fix that, right? And so they gave a public hearing last July, basically, invited folks such as People Joy to come and speak and sort of give ideas and advice on what could be done to fix it. So we spoke at that public hearing. And out of that public hearing, us and a number of other, individual members and individuals who were focused on solving this problem, came the limited PSLF waiver, which basically said, we acknowledge that the Department of Education said, we acknowledge that the 99% failure rate, we acknowledge that it was next to impossible to get forgiveness. So here's what we're going to do. We're going to look basically, if you follow certain steps, consolidate federal, certain loans and certify employment histories by October 31st of this year, we're going to let that time count. So we spent really the bulk of 2022 getting people to that finish line, getting individuals and borrowers there. But what I tell folks is, I look at that October 31st date as a game of Monopoly. It's a get out of jail free card that, if you've ever played Monopoly as a kid or with your kids, it was a get out of jail free card that expired on Halloween, right? Doesn't mean the game's over. Doesn't mean that public service loan forgiveness stopped after that date. It just means it gets difficult again. What I'm excited to announce is that on October 31st, on the date of the expiration, the government announced what really amounts to an extension of the program and said, for folks who didn't get their paperwork in by October 31st, and a lot of people fell within that bucket, we're going to basically allow you until May 1st of 2023 to get your affairs in order. So I'm telling employers, it's a second get out of jail free card. Again,
Timing is important.
timing is important. So there's a little bit of a sense of urgency in terms of if you had employees that didn't get it done. And what we hear a lot from Greg is a lot of employers will tell us, well, people drive, I see these PSLF forms, I'm signing them every day. So I'm doing my part. They're getting forgiveness. And signing that PSLF form is really 10% of what happens. Are your employees sending you the rejection letter that they get back in that PSLF form that lists every rejection type on one, but not why they were rejected?
Yeah.
Are they consolidating those loans that don't qualify? They were certifying that just simply filling out the form and sending it. If that were the issue, if that were all it was just signing forms and sending them, there wouldn't be a 99%.
That's right.
That was in the details, as it always is, especially when it comes to federal programs like this.
Awesome. Well, thank you, Mecca. I really appreciate the time and effort you and your team are doing. And please, for those on the webinar, reach out, get in touch, make sure you can talk through how Mecca and his team might be able to really impact your organization.
Thank you.
All right. That concludes the webinar, everyone. Have a great rest of the week and look for more webinars to come from the team at Exude.